now we're in this period of maybe deglobalization, or at least we're not globalizing the rate we were. Even if we keep our gains, we're not just rapidly globalizing anymore. And so we have, and then now we have much higher debt to GDP than we had before. So even smaller gains in interest result in much larger interest expense relative to the size of the economy from the public sector. And so I think that the same concerns that were present in the late 80s and early 90s are 30 years later reemerging their head. And this time there's no offset.
In recent times, there have been growing concerns about the fate of the United States economy and U.S. investors in the coming years. To begin with, there is the issue of the rapidly growing death spiral, a situation many experts agree will only continue to worsen with no end in sight. To add to that, there are also lots of concerns about the fate of the United States and the US dollar on the international stage, no thanks to the BRICS' ongoing agenda to dethrone the greenback as the world's reserve currency. All this is going on against the backdrop of so much political divide in the country, which undoubtedly makes it even harder to find solutions to the economy's many growing challenges, even if they are only temporary. According to Lyn Alden, a renowned investment strategist and macro analyst, the many challenges facing the economy now began rearing their heads in the 80s as the national debt surpassed the dreaded $1 trillion mark. Alden reckons there would have been bigger consequences of the rapidly growing debt somewhere along the line, but due to some factors, the U.S. economy was able to remain buoyant enough to keep the size of the economy above the interest expenses on the country's rapidly growing debts. These factors include rapid globalization, a profound period of productivity with about 1 billion people entering the global labor force, lower interest rates, and peak demographics in the United States, with the large baby boomer generation entering their peak spending years in the 80s and 90s. As a result of these factors, Alden says policymakers have been able to kick the can so far down the road, and there have been no serious consequences until now. Now, those problems are re-emerging, only bigger and much worse because of the much larger debt to GDP ratio. However, unlike the 80s and 90s, all the factors that helped the economy stay afloat are either unraveling fast or happening at a much slower pace than they did back then. The result, Alden explains, is that the U.S. economy is now in a very precarious situation and tilting on the very edge of disaster. The renowned macro analyst vividly analyzes the situation in a recent discussion from Blockworks Macro. In this video, we bring you some important highlights from the discussion, as well as insightful excerpts from Alden's July 2023 newsletter. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and drop your comments and observations in the comments section below. Thanks, and enjoy the video.
We can go back a couple decades to have a little bit of insight into this. So in the late 80s, due to the attempts of the Fed to fight inflation by raising rates so much, and then you had during the 80s, partially for the Cold War and other reasons, you had Reagan building up quite a bit of public debt. So we went from 30% to way above that. And so the combination of high rates and large deficits did start to actually cause quite a lot of interest expense by the government after a long enough period of time. And the late 80s and early 90s was kind of the peak period back then for concerns around the sustainability of public finances. So that the famous debt clock was put in place in the late 80s. And then you had Ross Perot run the most successful independent campaign in modern history, and his big thing was the debt. And so that era, the zeitgeist was really, you're hitting like $1 trillion numbers for the debt. It's completely unsustainable, and they ended up being like 30 years early because right when they were like in their crescendo of how bad this is, and all their reasoning was right, but then you had the fall of the Soviet Union, opening up of China, and you had this kind of 30-year period from, say, the early 90s to the late 2010s of rapid globalization. So we brought on 1 billion people into the global capital labor force. You had Western capital and Eastern labor all kind of come together. You had this profound period of productivity. You had structurally lower interest rates for decades, which then allowed that debt, so that even though the debt to GDP kept increasing, the interest expense relative to the size of the economy was flat to down. You had peak demographics in the U.S. So in the late 90s, early 2000s, you could run a surplus because those baby boomer generation was in now their peak like earning yield years, and so basically for 30 years, like those guys looked really, really wrong. And then you started the zeitgeist came to be the debt doesn't matter. Look at all those people that were alarmed about it. It's not really an issue. And I think the challenge is that going back to your question, that 30-year period's kind of behind us now. The same concerns that were present in the late 80s and early 90s are 30 years later reemerging their head. And this time there's no offset. There's no, we can't have another 30 years of structurally lower interest rates. We don't really have another 30 years of globalization. We have some productivity offsets from, AI and software and things like that. But when it comes to labor and energy and things like that, those are real constraints. And so I think in general, we're going to face more average inflationary pressure. The debt's going to be more of a political thing. I think you can see the politicization of interest rates. We've already seen it. Some example, we have Elizabeth Warren grilling Jerome Powell in Congress.
Yeah.
I think you could have similar dynamics where you get political parties based on the interest rates become more of a partisan issue. And as far as the end game, I think the big question comes down to whether or not they're able to reset this and keep it going, or if this is just kind of an era that ends and we enter a new era for money. Um, and so if they're able to kind of do what Israel did decades ago, or do what a lot of developed countries did in the 40s, and they say, okay, we're going to burn a lot of this debt off, and then we're going to pivot and we're going to get austere. That's kind of the bullish case for how this ends, which is, cash and bond holders get killed on a real basis, things stabilize, and then we kind of build from there. Or, we enter just a whole new era where the dollar kind of enters a spiral. There's not enough political unity to do anything about it. It just keeps getting worse and worse. And you probably want to own things like Bitcoin and gold and, hard assets. And we enter kind of we go through the looking glass.
In her newsletter, Alden compares what's about to happen to the United States economy to the adventures of Alice in the 1865 novel Through the Looking Glass by Lewis Carroll. In the novel, when Alice goes through the mirror, everything is flipped and different. Alden compares the Federal Reserve's strategy of raising interest rates to fight inflation that comes from fiscal deficits instead of bank lending to Alice standing in front of the mirror, about to take the ill-advised leap through. A portion of the newsletter reads, when sovereign debt is low and most money creation comes from bank lending, higher interest rates do exactly what we expect them to do, slow down loan creation and inflation. Alice is in the real world. When sovereign debt is high and as much money creation comes from fiscal deficits as it does from bank lending, then it becomes a tug of war. Higher interest rates have mixed effects as they do suppress private sector lending, but also increase the deficit by a similar degree. Alice is on the precipice of the mirror, but not yet through it. Alden believes the United States is currently at this stage with annual fiscal deficits already exceeding annual loan creation in dollar size, creating the tug of war that could eventually send Alice through the mirror. According to the renowned macro analyst, the third stage occurs when sovereign debt is extraordinarily high and far more money creation comes from fiscal deficits than from bank lending. When this happens, higher interest rates, rather than help fight inflation, become correlated with inflation. At this moment, Alden says Alice is through the looking glass and everything is wrong with the world as we know it. According to the investment strategist, there is a very high probability that this is where the United States economy is heading in the coming years. Let's get back to the interview as Alden talks about investing in this kind of environment.
So I think when you look at, say, stock market capitalization to GDP, for
Mm,
example, and other valuation measures, I think we've probably seen the peak. Um, and I think that a lot of these crowded areas are not going to have great returns on a real basis. Depending on what inflation does, they could
mm,
have positive nominal returns. But I think you're looking back a decade from now, we're looking back from the peak in late 2021. I think that the inflation adjusted returns from some of these major asset classes is not going to be very attractive. And the
mm,
question is, some of these other asset classes going to be able to provide some degree of alpha? So I think Bitcoin is an attractive one. Um, Gold is challenging, but if you do enter a really truly kind of sovereign crisis, gold is one of the things that central banks can use to basically recapitalize their system. So I think gold is another one to have a position in. And then looking out, I mean, I do think that there are areas like Brazil or India, some of these kind of third-party emerging markets,
mm.
that I think that there are kind of interesting long-term, like decade-long opportunities. And I don't think that the energy trade is done yet. We haven't really seen even a capex cycle, right? So we've not seen, for example, a whole nother cycle of bringing more oil online. And in general, even though we saw this big spike in oil and this big fall in oil producers kind of never really followed that spike. They never got over enthused, and then as the oil came back down, they're still appropriately priced for
Yep.
the current level of oil. Um, and so, we're seeing early signs that U.S. shale is running into headwinds. So as you've seen lower oil prices and recessionary concerns, there's not a lot of reinvestment. What makes shale oil different than these other resources is that you need rapid reinvestment in order to keep that production up. You get oil quicker, but you need to reinvest more frequently. And we're seeing rigs go down, the number of rigs. And generally, when you see that decline in rate of change terms, usually energy production, oil production, peaks some months later. And so we're kind of seeing initial concerns that we might be getting somewhat towards the top of our oil production range, at least in this cycle. Um, and so I still think in general the energy and commodity space is interesting. You just have to volatility manage it, right? Because if you go through a recession, if you go through other periods, it can do very poorly. But I still think that's an asset class for this decade. And kind of the way I'm describing it is when we think of the 60/40 portfolio, the problem there is that both bonds and stocks like disinflation. So bonds obviously like disinflation, and then stocks they like structured lower interest rates and no constraints on materials and things like that, so that all these big mega cap stocks can just keep growing and getting higher and higher valuations. Uh, Now, one way to augment that portfolio is to have a section that is kind of a defense against inflation. So it could be energy, could be um, copper, materials, things like that. Could be hard monies like gold and Bitcoin. When you have that slice, it helps you, I think, protect the other two slices in a portfolio. Instead of having all of your portfolio geared toward disinflation, have some of it that's geared towards disinflation, but then you have, a segment of it that's geared more towards inflation, so that no matter what happens, one segment will probably be carrying the other segment.
However you look at it, there are a lot of uncertainties in the future for the United States economy and investors. According to Alden, the United States may be about to follow the example of Japan, a major example of a country that has already gone through the looking glass, which means interest rate hikes are no longer an effective tool for fighting inflation. Alden notes that with Japan's public debt equal to about 250% of GDP, every 1% higher weighted average interest rate on Japanese debt would increase the fiscal deficit by over 2.5% of GDP. As dire as the situation might be in Japan, Alden explains that certain factors would make it even worse if the United States does go through the looking glass. These factors include Japan aged ahead of everyone else during a period when China ramped up its production and supplied everyone with inexpensive goods, helping to overcome labor shortages. Japan spends less than half of what the United States does on healthcare per capita, despite having a median age that is 10 years older. Alden adds that when the U.S. is the same average age as Japan, we may have 3 times the per capita healthcare cost as Japan. Not only does the U.S. spend more of its GDP on its military, 3 to 4% compared to Japan's 1%, but its reckoning is coming at a time when geopolitical conflicts are heating up compared to the 1990s to 2010s unipolar period. This is why Alden advocates owning hard assets like Bitcoin, which she describes as the ideal asset to get you through whatever storm the United States is heading into. In her newsletter, she states, I recommend holding actual Bitcoin for those that want exposure to it and learning how to self-custody it. I don't have a firm view on the Bitcoin price over the next 6 months, but I am bullish in a 2-year view and beyond. What are your thoughts on Lyn Alden's assessment of the current state of the United States economy and what's coming? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.